Hi, my name's Andy, and I've been watching a lot of YouTube videos um, about investing, and a lot of the videos I agree with most of them, but some of them I do disagree with, and I'd like to share my opinion on investments. And I'm going to start my own channel. I've got put together a little presentation for people who want to at least know my perspective on investments, just to see if it makes sense, and hopefully it helps you in your investments. So I'll go through the presentation. I'm an engineer by trade, and I really got addicted to investing and learning about investments, I'd say, for the past 20 years. So I'm going to share some of those lessons that I've learned throughout that 20-year period. So here's the presentation. So one of the things that I think is extremely important is to understand the cycles. And what I mean by understand the cycles, you need to understand what cycle you're in and how your investments are going to profit from those cycles. And this is meant for people who are more active in their investing, not people who just put money in and walk away. That's where the diversification thing comes in. And rebalancing. What we're doing is we're attacking the cycles that are favorable and profiting from those cycles. So when I was younger, I didn't know anything about cycles. I thought you just put money in investments and over time they would work, but there's cycles for stocks, there's cycles for precious metals, there's cycles for commodities. You have to get those right, because if you get them right, man, you can make so much money, and it's so quick, and it's so much easier. Another thing is to know the value, and knowing the value ties into understanding what cycle you're in too, because if you're at the beginning of a cycle, usually the asset is undervalued and nobody's buying it. So your risk is extremely low and your upside is extremely high. That's known as an asymmetric bet. Your downside risk is low and your upside potential could be many multiples. So that's important to know the value, because if you know the value and you know the cycle, you can reduce your risk. Another thing is volatility can be your friend. Volatility by a lot of people is seen as risk. And risk, if you know the value and you understand the cycle you're in, you're taking away that unknown or that risk. And volatility now, since you understand that, you can use that volatility to add assets to your portfolio at very low prices, which can be undervalued and before the cycle begins of its outperformance. And then obviously, I think it's kind of obvious to put this here, is buy when the cycle's out of favor. And the reason I put this in here is a lot of people want, especially new investors, want to chase assets. The fear of missing out. They see something going up and they want to participate and think that trend is going to continue. But in reality, when the public is buying something, it's typically at the top. And when you're buying things that the cycle is out of favor, you're going to be buying things when everyone is telling you that it's not a good purchase. So you're going to have to know the value. You have to understand the cycle and know that value to look at people who are telling you not to buy it because it is so low and it hasn't gone anywhere for years. And that's extremely important, because you have to know, and you basically have to just understand it yourself and block out everything else. And it takes a couple of years in my opinion, it takes a couple of years to kind of have that confidence in yourself, to have that confidence in knowing that value and that cycle, and going against the grain, because that's where you really start making a lot of money. So I'm gonna kind of paint a picture here of something that was out of cycle, and I think is coming into its cycle coming up, and the value is extremely good. So I'm going to go over a couple of things that the way or the paradigm that I see this kind of investment place, kind of how I view the world right now in the investment arena. So one thing I want to talk about is energy return on energy invested. It's important because as it mainly relates to oil. So if we're talking about like mining companies, and that's what I'm going to be talking about here is mining companies, and even just precious metals and metals in general, is back years ago, you'd poke a hole in the ground and you'd expend 1 barrel of energy and you'd get 99 barrels back. So you have a 1% kind of wasted energy and 99 in return to use that 99 in the economy, that energy to do work or to do whatever you want with it. As time progresses, and you can just see it generally if you just look anywhere, is that we're drilling and we're using mining sand to get oil that's sprinkled in sand, so to speak, and drilling in really harsh conditions, far underwater. We're going all over the place to get oil. And what that means is that we're expending a lot more energy to get energy, which means there's going to be less energy in society eventually, from oil at least, to do work. And it's important because mining uses, oil as an input to mining. And if we're kind of falling off this cliff of energy return on energy invested, what that means is as energy gets more expensive because you have less free energy to do work, I think it's going to impact the mining industry quite large. So we've got declining energy return on energy investment. It looks like right now we're at a 5 to 7 minimum requirement for society to function, and we're right at that 5 to 7 mark right now. So if this starts to decline, I don't think it's going to have massive impacts on everything in this world. It might, because you have to keep in mind that the stock market is based off of future earnings, and if energy is much more scarce than what they thought the energy would be in the future, it could impact future earnings of other companies. But from a mining perspective, if their input is oil and oil prices are going up quite a bit, which I think they will, that means that the price of the metals and the price of mining is going to go up. So the next slide, on top of declining energy return on energy invested, you've got declining ore grades. And I chose silver because everybody seems to like silver so much, especially on YouTube. And I like silver as well, and I have a lot of holdings in silver, which is good. But here's the average grade of the 12 largest silver mines, and over time you can tell that the silver grades, or the ore grades, have declined by 36% in 10 years, right around 500 grams per ton, all the way down to just over 300 grams per ton. And that's important because you've got declining energy return on energy investment and declining ore grades. And if you're younger, if you're in your 20s or whatnot, and you're looking to buy precious metals, let's say, over the next, let's say 30 years, 40 years for you, when you're 50 years old, I mean, some of this stuff might be pretty tough to get out of the earth. And I don't know if I really prescribe to just sending up a bunch of rockets and mining asteroids or something like that. I mean, the price is going to have to go up astronomically for that to work, at least with today's technologies. But this is just something to take into consideration, is that we've got declining ore grades on top of declining energy return on energy invested. Now, I'm going to go to the next slide. This is the cost of mining silver. As you can see, the cost of mining silver has declined recently. So it doesn't look like the impact from declining energy return on energy invested and declining ore grades has affected the mining costs yet. So they're still declining. We probably have very good technology going into the mining industry to increase how much ounces of silver that they're getting out of the tons that they they process. So, but at some point I think it's going to have an effect, especially if oil goes up quite a bit in a commodity boom. So one thing that I think is very important to understand is relative value. And relative value, I always look at things in a ratio. And I have up here a gold to silver ratio just to give you an example of how you could swap one asset to another asset and then swap it back. And the wealth that can be created and purchasing power gains that can be created by just swapping two assets. And this is a very simple example. So you can start with 100 ounces of gold. And on the left-hand side, this is how many ounces of silver that 1 ounce of gold can purchase. So down here, we would say that gold is cheap. So we want to buy gold, and up here we would say silver is cheap, and we want to swap our gold assets to silver. So if you start with 100 ounces of gold, and this is irrespective of the actual price, this is just the ratio. So we start with 100 ounces of gold, and we ride it up all the way to a ratio of 80:1 to silver. So we swap our gold into silver. So at the top here, it's 80 times 100 ounces is 8,000 ounces. Then we ride our silver that we just accumulated over time, and it hits a 45:1 ratio of gold, and we swap our silver to gold. Well, right now we've got a 177.8 ounces when we did that swap. And if you look back, we started with 100, and now we're at 177.8. That means that we increased our wealth by 77.8 ounces. So you kind of have to look at this and say, well, that's irrespective of the price. The price could be going up, the price could be going down. It doesn't matter. You increased your wealth by 77.8 ounces. And you go through this scenario where you're swapping to silver, swapping back to gold, swapping back to silver, swapping back to gold. And here, let's say it's 80 to 2010. That's a 30-year, maybe that's a working career of somebody for 30 years. You started with 100 ounces, and now you're at 562 ounces of gold. That's 462 ounces more. And that's doing 0 additional investments. This is just swapping two things back and forth. So you can increase your wealth by using a ratio between two different assets. It doesn't have to be gold and silver. It can be any two different assets. It could be the Dow, and I'm going to show you an example next, where you just swap back and forth and increase your net worth or your wealth throughout time without even adding any additional money. So I think this is a really good thing to understand, because this can tell you what's underpriced or undervalued at that time is by using the ratio. And I'm going to go into the Dow to gold ratio next to show you kind of what's of good value today. Is our stocks good value, or is gold good value? So we look at this chart, and we've got a Dow to gold ratio. This is for the past 100 years. So whenever the ratio is high, like up in this region, like let's say above 15, that means that gold is cheap. Anything below 5 means that the Dow is cheap and you want to buy the Dow. Now, if you're looking at this, we had some extreme valuations. This was the bottom of the gold market right here. This is one of the things that tells you what's underpriced and what's overpriced. So the Dow is extremely overpriced at this top here. And it was extremely underpriced at 1980 when interest rates were high and gold was making a top. So you want to ride the Dow up, and you want to swap your asset somewhere in this congestion area to gold. So what this chart is telling us is that we've got a declining area where gold is outperforming the Dow, and I think that's going to continue going forward. And this also states that the Dow is still extremely overpriced. So gold underpriced, Dow overpriced. You want to be looking at precious metals and commodities. I put up here a platinum to gold ratio, and why I chose this chart is I think platinum is extremely cheap. This is from 71 to 2016. I can show you. The next slide is a newer chart, but just look over time where platinum would buy 2.5 ounces of gold in this region. That's 2.5. Platinum would buy 2.5 ounces of gold Right now, gold can buy over 2 ounces of platinum. And if you look at this kind of average here, it looks like it's like, 30%, 1.3, 1.5, somewhere in that range of how many ounces of platinum, or how many, 1 ounce of platinum can buy 1.5 ounces of gold. It's kind of that historical ratio. Right now, we're at 0.477. That's the current ratio. So if you go back, we're below this 0.5 area. I don't know if it's ever been this cheap, platinum, in relationship to gold. Now you got to look at, what about silver? I know a lot of people love silver. I like silver, and I've been buying silver the past, years back, and I'm buying platinum now. And you'd say, well, why are you doing that? What's the relationship of platinum to silver? We want to buy the most undervalued metal. All right. So here's the platinum to silver ratio. This is a chart going back, to 70. And some things that you notice is, it low, the lowest it's ever been is like 20. So we know platinum's cheap to gold, and this is showing us the current ratio is about 34. So 1 ounce of platinum can only buy 34 ounces of silver, and it might have even declined even more than that recently. So let's say it's around like 30-ish. We're scraping bottom here, everybody. We're this is super cheap. This is an opportunity, in my opinion, to be buying platinum. Doesn't matter the reasoning behind it. Doesn't matter why. And if you look at the platinum to palladium ratio, palladium is $2,300. Platinum's a little under $1,000. It's over 2 times as expensive, and that is extremely rare. Usually platinum is multiples higher than palladium. So anyone who's going to use palladium should use platinum as a substitute. I don't know why they would use palladium if they can. So platinum is a screaming underpriced asset in relationship to the Dow, in relationship to silver, in relationship to gold, and in relationship to palladium. It is extremely cheap. Now, what about its relationship to its own price even? So here's a platinum trend line with a 95% prediction band. This only goes to like 2018, but we got down into the 700-800 range, which is below the band. We're over here, and then looking at history, this is off the charts underpriced. I think this is a huge opportunity to be buying platinum and loading up on platinum, irrespective of what. Oh, it's used in catalytic converters. Well, so is palladium, and palladium's going through the roof. So what do you think car manufacturers are going to do when palladium's at $2,300 or $3,000? They're going to say, put in platinum if we can. Put in platinum in wherever we can. All the substitutions are going to be platinum. It's not going to be palladium. So I would be buying platinum, and the investors are doing the same thing. They're saying, let's go buy some platinum. Why would I buy palladium? It's overpriced. And here's the mining cost. These are for South African platinum mines. This is from 2017. I just like the chart. It's easy to read. I also, South Africa produces about, I think it's 80% of all the platinum in the world. So this is the majority. And what you need to look at is the high cost producers here on the right hand side in the red. Those are the high cost producers. And if platinum is drastically under those high cost producers, they're not going to produce, and they're going to pull back the supply of platinum over time. So we are under the mining costs of the high cost producers at $900 something an ounce. And we're even probably cutting into some of these other medium tier cost producers. So, when you're below the mining costs of your high cost producers, this is an excellent time to be looking at platinum and buying physical platinum. Because you got to keep in mind those ore grades are declining. The costs of energy return on energy invested should go up for mining. So I think these costs may increase in the future when energy goes up drastically. And I also did a case study of S&P 500 versus precious metals. I hear Dave Ramsey, I hear all these people on YouTube. Gold only returns 1%, or they make all these claims, and I just want to know what the facts are. I don't really care about the claims. So I ran a little analysis. Is from 1990 to 2020. It's a 31-year period actually is what I used. That's about a working career of somebody. So if someone just started out working, and I was giving advice to myself when I first started working. I'd say, you know what, you got to understand the cycles, you got to understand the value. So what is the value of investing in the S&P 500 versus precious metals? Because no one really talks about precious metals. So the S&P 500 putting in $20,000 a year for 31 years, which is $620,000, excluding dividends, because it makes it a lot easier for this calculation, is $2,149,000 is the total return over that 31-year period. Precious metals, using all 4 precious metals, so platinum, palladium, gold, and silver, and looking at the ratios for buy points. Whatever's the undervalued metal, you start buying that metal. Right now it's platinum that I showed you throughout the slides. And if you have done that over that period and just held on to the metal, there's no swapping metals back and forth, just holding on to them, your return would be $5,280,000. And another thing to think of, and not just the return, but you're doing it with less risk. When you hold a piece of metal, it's just a piece of metal. There's no currency risk. There's no interest rates jacking around with your investment. There's none of that stuff that you're subject to. And also, if going forward, if politicians want to tax things, they could look at a 401k and just take it from you. If you have the physical metal, it's very difficult to. I mean, what are they going to do? Come here and just take your metal? I mean, perhaps they can tax it a large amount for when you sell it or something like that. But I think it's a lot more difficult to tax it and take it from you outright. And one thing when doing this ratio or the buying throughout history is that historically we'd be buying a lot of palladium and holding a lot of palladium. The palladium is really what was been underpriced and where that value was derived from. It wasn't from silver, it wasn't as much from gold, and it wasn't from as much from platinum. It was mainly from palladium. So when you look at the assets that you're buying, I mean, some of your opportunities might be outside of the gold and silver arena, and it might be more in the platinum group metals. And if I added rhodium into this, it'd probably just go vertical your return, because rhodium has done some insane stuff recently. Yeah, that's all I wanted to show in this clip. So, you know, I really appreciate you guys listening to me, and hopefully this first video helps you out. I'm going to cover a whole bunch of other stuff in the future, and you know, maybe if you subscribe and listen to this channel, maybe it will help you, and maybe you can learn something that will help you with your investing career. So, thank you.